The sort of discussion by, I just heard some conversations in the morning and I spoke to some people. So there's a wide range of audience here, people who are thinking of starting a business, thinking about how to get funds to get that business started. There are others who have raised money already and are facing challenges in thinking about how to grow the business. There are others who actually have large businesses, existing businesses, thinking of new businesses to enter into and therefore need capital to grow, right? So there's the wide range of questions that are there in people's mind. So I'll start off the discussion in a very generic way, and I think it's so what's the topic for today is how do you think about what do you think about when you want to raise capital for your business? What should you be thinking? And I'll take a slightly different tack on this from an investor perspective. What are we looking for? That's one aspect of it. And therefore, as a company, what should you be? How you should be presenting? How you should be? That's one part of it. The second part of it is how should you be looking at an investor, right? So one is how do you think about raising investment, and the second thing is how should you be looking at an investor coming into your business. So the two parts to this that I'll discuss. So let me first start by outlining what do we look for. And therefore, in the reverse, you guys would sort of know what is it that you need to do. So the first thing, obviously, is we look for a team or an individual that's building the business, right? So you have to, but again, take the opposite. You have to be able to think through and say, if I go and talk to an investor, why would this investor put money behind me, right? So have a clear viewpoint about yourself. Why is it that the business that you're doing is you are the best suited person to build that business, run that business, and so on, right? So that's the first piece of anything that you do. You have to go in with a sense of confidence that is so apparent, that I can make this happen. I can make a large business here, and this is why I can do it. So you have to internalize this. You have to think through. There's a notion of self-awareness that comes with that. That what is it that this business needs to succeed? What do I have that I'm good at, and what is it that I'm not good at? And once you do that, then you say, okay, if I'm not good at something and this is something that is needed in this business, and if I go to an investor and I say, hey, give me money, and the guy says, oh, what about this? And you're not able to answer it, how will you do it? So then what happens? You start looking for a co-founder. If you're an individual, you start looking for a co-founder or someone to fill in that gap. So the first part of this is, getting ready for investing, is that you need to be self-aware of what the business needs and what is it that you have, and therefore how do you fill in the holes that they're in, right? That's one. The second thing we look at is the market. How we normally, as any investor, an investor is looking at you targeting a reasonably large market. Now that sense of largeness varies on the nature of investor. So an angel investor who is saying, okay, I'm okay getting dividends from this business, or I don't need a huge exit, may be agreeable to a smaller market size. So let's say that you are going to set up a gym in your neighborhood. It could be a good business. You could be making a lot of money, particularly if you do it in the right way, you can make a lot of money. But if you're only going to do one gym, then that's not a large market. It's catering to your neighborhood. Now, there could be, your uncle, there could be your friend who says, I don't want to deal with the hassle of running a gym, but I agree it's a great business. So I'll give you a crore or whatever, to run this business or start this business. And in 2 years' time, 3 years' time, you sort of say, okay, I'll give you a 10% dividend or a 20% dividend year on year. So it says, I'll get 20 lakhs 3 years later, which is better than having a bank loan. Okay, so that person is thinking along those lines. If you come to me and I say, oh, a single gym, I can't really get an exit for this, so is this the right thing for Nexus? So we probably won't do it. But if you come to me and say, not that I'm saying that I'm going to fund gyms, but if you were to come and say to me that, okay, I'm going to set up, what's a big, Talwar, let's say, right? So I'm going to set up a gym that goes all across India, and by the way, health and wellness is becoming a big trend in India. There's a huge market for this, and so therefore I can see that there's a gap in the market which I can fill. So will you fund me, right? So there the money requirement is probably more than 2 crores or a crore or whatever else. You say I need at least 20 crores to set this up in 5-6 locations, set up a corporate infrastructure, and so on, and therefore I need more money, right? So there the question comes down to your investment amount is higher. The nature of investor that you want is different, because this is a person that is looking to a much larger exit, and therefore is looking for a much larger market. So the second part is this understanding of the market. Which market are you targeting? Therefore, which investor are you going to approach? Okay, so you need to be very clear on that. Now, why would a person say, I will always go and target the largest market? Why would somebody say, I'll only target a smaller market? But everybody has different aspirations. Some people will say, I don't want to go and deal with the hassle of running a multi-location, multi-city operation like Talwarkar's. I'm fine. I'm a fitness fanatic. I would love to do something in my neighborhood, but I don't want to deal with this hassle of running around and traveling and all this stuff that is required in the corporate setup. So there's no wrong or right answer for what business you choose to start with and how big you want to scale it. But what it does matter is how do you think about the investor that you're going to go target. The third thing is, what is the differentiation that you are bringing in the business? So obviously the biggest differentiation is yourself. That's the number one thing, right? We said that the first thing that you have to be able to convey to any investor is that as a person, I'm different than any other in the market, and I can do something that others can't do. That is what, otherwise somebody else would be doing it, or somebody else would do it, or so on, right? So the key thing is, apart from you as an individual, you as a team, the differentiation. The other thing that you will look at is what is it that you're building in your product and your service and your solution that is differentiated. And so again, that goes back to this notion of awareness. You need to be aware of what is there in the market, what does the customer need, what is the what is it that you can build. So you may have a great idea that this is how you would differentiate yourself, but the cost to differentiate may be so high that it becomes unreasonable or unfeasible in the price points that you can charge. So those are all the issues that you have to sort of keep in mind. And then the final thing is you have to show some level of capital efficiency. In the context of any investor, starting from somebody, your uncle who's giving you 20 lakhs to get a business started, to Blackstone that may be giving you $200 million to build a power plant. Everybody is looking to make sure that the capital is deployed in the best way possible. So you have to show that whatever you're going to do is going to be done in a manner which preserves capital, which returns the best, which gives the best return on the capital that is invested. So thinking through that, you may not have a Excel spreadsheet or whatever, but thinking through what are the ways that you will address capital efficiency is very important. Right? So those are the 4 points that I would say you need to think about in reverse, right? I'm just thinking, this is the 4 things I'm going to be looking at. So as entrepreneurs in reverse, you have to know that this is what I'm looking for, or any investor is looking for, and therefore how am I going to convey these to the investor. So that's from a thought process of how to go about raising funds. Now what investors to go and target? So the first thing, like I said, the size of your market, the size of the business you want to build has an impact on what is the nature of investor you go after. So my partner Sudhir has a very interesting sort of moniker for this. So he says this is the art of investing. So what does the art stand for? There's no science to this. Actually, we have no idea when we invest behind a business whether this is going to be a huge success or not. If it was a guarantee, then everybody would be doing it, right? So in effect, we are taking a bet on on the individual, on the market, and so on. So it is a fundamentally art of investing. So if it's art of investing, what is the art? What does the ART stand for? So that's what he sort of came up with this idea. So he said A is basically access. So now I'm taking this thing around, what is the art of choosing an investor? So the first thing you have to look for is the person accessible. So if it's taking you 30 phone calls to get to this person, then that person is probably either too busy or doesn't believe in your market, or doesn't believe in the opportunity, or whatever else. You'll be wasting time trying to get to that person and convincing them. Now, there are obviously obvious exceptions. If you want to go to Narayan Murthy tomorrow, how will you, even 34 calls will not suffice. So, there is a notion of access which you have to think about, but would Narayan Murthy be the best investor for you? Will he have time to spend with you one-on-one on your business? Right? So those are kind of things that matter. So think about the accessibility of the investor when it comes to working with you. That's one. Second is, R is relevance. So relevance is very, very critical, as I said, what I just described, in the notion of one of the biggest problems that we see is that people become investors for the wrong reasons, and people choose investors for the wrong reason. So, and that relevance is very critical. Now, if I'm setting up a business in software, a software product, and I go ahead and take a real estate tycoon as an investor, because that guy has got probably in today's market probably thousands of crores lying around, and is saying that what do I do with this money? So he says, software is a great space. I can talk about it at parties. I can tell people I have this little software company that's running. So he's doing this for a completely different reason than why you're doing it, right? So he is saying everybody versus real estate guys, but software is a very sexy space. So I'm going to get into software. I don't know anything about software. I can't go and set up a company. But I'm going to, this bacha came to me and he said, oh yeah, Akhil, I want to start a software company. I'm going to give him 50 lakhs to start a company, and I'll take whatever, 10%, 15%, 20%, whatever. And I'll be a shareholder. So great, the guy says, I got 50 lakhs, I only give 10% of my company, I'm all set. Why is he not all set? Because although he's got the money, it's not money that's relevant. You may be a great entrepreneur, and there are people who can just take the money and make something with it, but then it goes beyond that. So you run into problems where you now need to go and figure out how do you market this software product, or how do I hire someone. So let me start with the first thing, the hiring part. So you want to hire someone, and you want to get this really good guy, and he works for Symantec up in Pune, and you want to convince him to move to Bombay. So the guy says, okay, where, are you well funded? He said, I have money. How much money do you have? I have 50 lakhs. You won't tell him, he said, I have lots of money. So who's your investor? Oh, I have, this real estate tycoon who's my investor. What do you think the software guy who's sitting in Pune with Symantec is going to say? Will he come and join? Most unlikely. Because he has no context of who this real estate guy is. Will he give you more money? Will he be able to help you scale this business and so on? The first problem that you run into is hiring. And I've seen this, and this is actually, this is a real example. So this is a guy who came to me after being with this real estate investor for 7 years. And when he came to me, he had built a tremendous product. Just out of sheer dint of, I guess hard work. There were 3 guys, had built a phenomenal product, but had a real estate investor who had no clue what to do with this company. And to make matters worse was, because this has been around for 7 years, hadn't seen any return on his investment and all that stuff, was, giving this guy a head, right? So this guy came and said, I need to, so we tested the product. There were customers using the product. So we said, okay, fine, this is where you want to go. And when I started working with the CA, so there was a CA involved in this. So I started working with the CA. I worked with the CA for almost 5.5 months, trying to unravel this earlier transaction. And finally, I given the term sheet was signed, everything was done. 5.5 months later, I said, it's not worth my time. I backed off. But I really liked the guy. I actually introduced him to, this was a guy in Bangalore, I introduced him to another fund. But I said, there's something here, this guy can actually build a business. The fund, continued from the 5.5 month journey, and 3.5 months later, so almost 9 months later, this guy, almost like a baby being born, right? So this was 9 months later, they finally did the deal. So, but the guy lost 8 years of his life by choosing the wrong investor. 7 years in the initial phase and then another year, and the market doesn't wait for you, right? The market is moving on. So the relevance, finding the person who is relevant to your business is very important. Just don't take money for the sake of taking money. Try and understand where have they invested before. Try and understand what are the relationships that they have. Try and understand what is it they understand about your business. It's not that all real estate investors or real estate guys don't understand software. Maybe there is a real estate guy, whose father pushed him into real estate because of his family business, but he had done his computer science from, Carnegie Mellon. So there are guys like that, wanted to be a software engineer, but just couldn't, right? So there are sort of always exceptions to the rule, but make sure that the person is relevant. So that's the second thing. The third thing is T. T is trust. Okay. Now, why is trust so important? So I think you keep hearing this. Taking the investor in your company is almost akin to marriage. You don't know how long this will continue. In some cases, there is a signed divorce paper at the start which says in 6 years we will divorce, you will sell the business, all that stuff. But in most cases, you have no idea how this journey is going to go, right? So it's very important. The same way that you choose a life partner, it's very important to sort of figure out that this is a person I can trust. Because what will happen is, as you build your business, there will be many situations where there will be reasons for mistrust. Right? There could be made an you're running a retail chain, and you make an investment and you take a large property on lease. And that property happens, and you disclose this, that this property happened to be owned by a friend of mine, but he's giving me a great rate, so I'm taking a larger property. For whatever reason, that particular location does not work. It's not your fault, it's not your friend's fault, but it didn't work. The investor sitting in the back is saying, was this deal done because this guy was trying to help a friend? You may have disclosed everything and so on. So simple things like that, you hire someone, right? And so there are always conflicts of interest in any business. There's always divergence of opinions as the business grows. You may say, okay, I want to go focus on the Bombay market. Your investor who's sitting out of Delhi says, no, I want you to be more local. Please come to Delhi. So there are all sorts of divergences that happen as your business grows. So that level of trust has to be there on both sides. That you could be building a business without having to always look back, across your shoulder and say, what is this guy going to think if I do a certain thing? Because if you start spending time thinking about your investor versus thinking about the market and your competitors, you're losing valuable time. Your investor should be pushing you ahead rather than pulling you behind. And so it's very important that that trust gets built on both sides, where the investor is saying that this team or this individual is doing whatever they can to the best of their ability to generate the highest return for me and my money. Right? That's what the investor should be saying. And what the entrepreneur should be saying is, this investor will do whatever it takes to make me successful. When you get to that level of comfort, that's when things start working and humming. It becomes even more important because as you scale, you bring in multiple investors. It's not just one investor, the next investor comes. The next investor may have a different point of view than the first investor. So now you have 3 people in the kitchen, right? So you have to continuously make sure that your trust levels are extremely high. We have a portfolio company, for example. I was the initial investor. Company did phenomenally well, grew almost 4 times in 1 year after a capital. We brought in a second investor. The guy came in, and there was one thing that we did which wasn't quite perfectly documented. We said, oh, there's a huge risk here. We need to bring in a KPMG and we look at this and so on. And as KPMG got involved, started looking at this. It took about 3 months to make that happen. At that time, for that period of time, that activity that the entrepreneur was doing was put on hold. We missed a complete season for that particular activity. The next year, the business was flat. The entrepreneur and the new investor, the investor comes and says, hey, I had invested with the idea that you're going to double your business next year. Why has it didn't happen? The entrepreneur is saying, you put me in this straitjacket. If you had allowed me to run my business the way I was running it, I would have been 2x. So it's in no way was this anybody doing anything wrong. The investor was doing the right thing. A lot more money had come into the company, so they wanted to make sure it was, the risk management was in place and so on. So they were doing the right thing for their fiduciary responsibility. The entrepreneur was doing the right thing in terms of trying to grow the business as fast as they can. So everybody has good intentions. Nobody has bad intentions, but the trust got broken, and that caused the business to slow down. So very important to get trust. So those are the three things that I would say from a, when you're thinking about an investor, look at those things and see before you decide with someone. Make sure that that the person is accessible, the person is relevant to your business, and third, there's a mutual trust. So with this, I will stop and I will open the thing to we'll make it more interactive. And what as he said, what I request is that before you ask the question, just introduce yourself and the business.
So thanks, Sandeep. And just before we open it for Q&A, a quick question maybe from the audience and a little bit of questions that have always been coming to Thai from a bunch of entrepreneurs. So while we look at the ART that you've just defined, if entrepreneurs still go through that, there is the ART in the before they sign the contract. But along the way, maybe 6 months down the line, a couple of years down the line, things start going rough. How would the entrepreneur relook at it? Should there be an exit? Should they try to work towards some mutual things? Because things don't really run the way everyone dreams it to be.
So if you're in a situation where there was the art of investor choice had been made, and you initially took on a person that was aligned with you, but for various reasons that alignment broke over a period of time, what do you do? So I would say that the right answer would be to find a graceful exit. Now what you have to think about is what is the rationale behind why this sort of misalignment happened. Could be various reasons. One of the reasons is clearly that your perception of a market and the investor's perception of a market is very different. You may feel that the market is not growing as fast, therefore you want to conserve your resources and grow slower. The investor has a defined time frame in which they want to exit, and after 3 years, they're sort of looking at the clock and saying, I have maybe 2 years or I have 3 years to exit. How are you going to get me there? So one potential misalignment is because of that time horizon. So that is a slightly easier one to handle, because you can find another investor that again maybe has a 5 to 6 year horizon, who is willing to buy out the first investor and continue with the company. That investor has to believe that their growth path will be aligned with yours, and they believe that the business will go slower, but what you are building is so valuable that in the long run you will actually create value for everyone. Investors also have different return profiles. So our return profile, for example, would be much higher than a later stage private equity player, because we do as a venture capital firm, we will invest say behind 20 companies, but we expect that we're taking much earlier risk, that some companies will give us a 10x, 20x, 5x, other companies may flame out and not give us any returns. So the guys who are getting us a 10x, 20x have to grow much faster. Now, but you don't know which of your companies are going to give you that 10 or 20x. So we have to go in with the assumption that each company will give us a 10 or 20x. Right? Because we can't identify at the start that this company is going to go 20x, this one is going to give us 0x. Can't, that's not unfair. That's unfair to the entrepreneur. So we are going in with the assumption that each company is going to give us a 10x, 20x, which means therefore our expectation on growth rates are much higher. A private equity player, when they come in, which is much later typically, is that I expect 3x to 5x return over 3 years, let's say. 3 years, 3 years to 5 years. So there the expectation mismatch, when you're talking about a company that's likely to grow more slower, but is going to focus on profitability and so on, maybe more aligned with the private equity player. So if I'm an investor that came in early, you may come and say, Sandeep, listen, we can't grow at 5x anymore, 10x anymore. Why don't you sell out to somebody who's okay with a 1.3x, 1.4x return in the next 2 years? So that model works. What are the other things that can impact? Trust. If trust breaks down, that's a very tough one to solve for. Why is that? Incoming investor. So let me take that back. If trust breaks down, I think the only option for you is to find a way to buy out the investor yourself. It's very hard to find another investor to come in and invest in that business, expecting that the trust will be maintained with them when it wasn't maintained with the earlier investor. It's a pattern. Our approach on making investments is very much pattern driven. So we look at patterns and say that, because again, whether it's with people, whether it's with markets, we are always looking at patterns and saying, this is what happened earlier, this is what is happening in the market, what we see, this is how CIOs are behaving, this is how customers are behaving, therefore this is the business that's likely to succeed. So we're looking at patterns. So this is one of the patterns. So the pattern is that there is a breakdown of trust between an investor and an entrepreneur. If it's happened once, is it likely to happen again? So when I as an investor am looking at, on average, we as a firm, we're looking at maybe 2 to 3 plans a day. Right? When we're looking at that level of velocity, then anything that has any quote unquote risk associated with it, we'll just say it's not worth our time. So that is a much harder one to resolve. So relevance, I think if you don't, relevance has to be done beforehand. That is something that you can't change after the fact. Once a person is an investor, that person hasn't changed. He's still relevant to you. So that discussion is that clarity has to happen.
Thanks, Sandeep.
Good morning to all of you. My name is Priya. I am working as a marketing manager with Novartis. I have more than 12 years of experience in pharmaceutical industry. Now my basic question is regarding, since you are an investor. So far I have attended lot of sessions in time. The overall the feel I'm getting is that investor is more like a boss. Like suppose he's investing in a business of an entrepreneur. It's like that entrepreneur has another boss. Now I have been in the industry for 12 years and I'm tired of bosses. It's like, they just dominate you, they want things their way, they suppress you, you cannot be transparent. And one of the reasons is, why I want to have a business is because I want to be independent. I want to have my thinking, my style of working. And again, if I'm looking out for funds and I'm getting another boss, so that is what I'm getting a feel. So I'm not sure. I want you to clarify this thing. What is their role? What is the operation? How are they supposed to report? What is the MIS and all those things? Yeah, please.
That's a very good question. So, this notion of being a boss. A lot of people ask me. I did a session with the Mumbai Angels once, where the discussion was around. How are you a good board member? And I don't claim to be a good board member. There are people who are probably much better than I am. But I'll just share with you what I look as board members. So board member is effectively a coach. Okay, so there's a big difference between a boss and being a coach. Okay. Can anybody sort of maybe I'll just ask people, maybe I'll start with you. What's the difference between a boss and a coach?
Basically, a coach is somebody who counsels you, who will develop your strengths. If there are any points of improvement, he'll work towards your development. If you face any problems, he'll guide you. He'll be more like a leader and he'll create leaders under you. Whereas a boss is somebody who would suppress you, not give you any freedom.
Okay, so
everybody says we are a coach,
okay.
But at the end of the day, they all become the same.
Yeah. What's the difference? What's the difference?
A coach is invested only in you winning. Boss will be having a lot of intention in back.
Okay.
boss is someone who gives you money, and coach, you have to give money to.
That's a good one. That one. But okay. So what is the difference between a boss and a coach? Okay. The biggest difference I would say is a boss has the right to fire you. A coach typically, a coach can fire you as well. As Shane Watson found out recently, he got fired, right, for a test match, and he was fired by his coach. But typically, the biggest difference is, as you, I think you pointed out, right, the coach, the primary goal that a coach has is making sure that you win. Now, in effect, the boss has the same goals. They're obviously, if it's a one-to-one relationship and the boss doesn't have to deal with anybody else but just you, then the boss could effectively be a coach. But that unfortunately is not the case. And so the boss may have his own boss, or the boss may have 20 other people that he's managing along with you and has to manage across all of those things. So there is there's a subtle difference, and that difference, I think, what you outlined is a boss is seen as someone who's repressive. The word boss is seen as something that is repressive, versus a coach who's seen as somebody who's supportive. It's only a matter of a choice of words. Okay. I tell a lot of people, I say, switch your, even at work, and this has got nothing to do with, you guys are all entrepreneurs, but take your point of view as why you went ahead and did this, and apply this to your employees. And the most important thing is you have to convince your employees that you're a coach and not a boss. The boss has a very negative connotation, and she has outlined what that negative connotation is, and a coach has a very positive connotation. So it's very important, particularly in an entrepreneurial setup, that every individual that is working with you feels that you are invested in their winning. I think to his point, a coach makes each and every person on the team feel that he or she is trying to get the best out of them. That is the bond, or the sort of thing that the coach signs with his pupil. That I will make sure that I will try and get the best out of you. And that is the most important thing for any entrepreneur, to convince his or her team that I am trying to get the best out of you. If you come across as a boss to your team, there's a problem. You will give deadlines, you will give directions. That's your job. But you do that in the context of saying, I'm giving those to you to make you successful. If you're successful, I'm successful. If I'm successful, the business is successful, right? That's the positive sort of mantra that you have to get into your organization. That's the positive energy you have to create. So that's in the entrepreneurial sense. Now, why did you choose to be entrepreneur? But in her case, as she's saying, I don't want repressive bosses.
See, that is just one reason.
I know that the market is there, all this stuff. You're answering your specific question. So, if you're going to go and raise capital, then in some ways you are going to have to answer to someone, right? Because that capital is not coming as a freebie. That person is there is an expectation. See, what is it about a boss or a coach or whatever? It is fundamentally about expectation. So now, whether the expectation is unrealistic or whether the expectation is realistic is something that you as an entrepreneur have to manage. Okay. So if you go in and you raise money and say, I'm going to build this business and the next year I'm going to grow 10x. And in the back of your mind, you're saying, I can only grow 2x. But this guy will not give me money if I tell him it's going to be a 2x growth. What have you done? You have set yourself up for a boss situation. This guy is going to come to you, in 8 months or 6 months, whenever he starts seeing that the 10x is not going to happen, and he's going to start sitting on your head and say, where's the 10x? I gave you money based on 10x. Where's the 10x? Okay. So that expectation setting is what is driving this behavior. It's not that he wants to be your boss or whatever else, but you have set up an expectation, and he's trying to to work against an expectation. So expectation management is very important. So if you do that, I can tell you that a good investor is not going to be your boss. But that expectation management is a two-way street. So if you set up expectations, you need to manage them on an ongoing basis. So what do? You give a MIS not because the guy is asking for a MIS, but you are giving it an MIS to keep that expectation management in place, so that the person is not guessing. See, you are doing it for you are not doing it for his good. He's not asking you to do it. You are doing it selfishly for your own reason. You don't want that guy to ever call you. So if you give a MIS on a regular basis, which is beating the expectations that you have set, there is no reason for the guy to call you. So the only time when the guy will call you is when there is some positive news. You say, I met this guy in a party yesterday, and he wants to give you more business. Then you go and see him. Or this guy there was a great person I met. I think he'll be a great CTO for you. Why don't you hire him? That is the level of discussions you want to be having with your investor, not what is the sales that you've done this time? What is your profit? How many people have you hired? How many people have you fired? Right? That sort of stuff you don't want to get involved in. As an investor, we don't want to get involved in that either. We are running our own businesses. At the end of the day, we are running our own, whether it's an angel or whether it's a VC, there are many other things that we are doing. One cannot run your business on a day-to-day basis. Again, that's the difference between a boss and a coach. The coach, interacts with you on a short while, but when you're playing the game, you are playing the game. Whether you win or lose, it's your loss. Whereas in the case of a organization where there's a boss, if you lose, the boss's numbers are also going to get impacted. Right? So it's a little bit of a different hierarchical structure in that case. In the case of an investor, the same thing applies. As long as I'm getting my expectations, I'm not going to go and sit on your head, because I have 10 other things to manage. I have 4 more entrepreneurs to invest behind. So why would I spend time if I don't have?
Hi, this is Nikunj Bubna. I am actually a co-founder of Unique Consumer Services Private Limited, and after our 3.5 years of successful, not so successful pivots, we have actually arrived at a fabulous product. I'll skip that part. I'll jump to the question. I could not agree much more than you on the art part. I totally agree with you, ART. But let me dare to add 2 other words to that, S and M. S stands for speed, M stands for minimalistic in terms of interference, legalities. So, as you said, investing and early stage investing is like a marriage. Generally, all those married out here will agree that even in a marriage, you don't get all the things in your ideal partner. Some of the places you have to compromise. So when I take 5 things, S, M, A, R, T, probably, when speed and, M and, add those 2 things, probably one of these get compromised. That's the reason why, we don't know where to prioritize. And only once you make a mistake or a goof up sometime later by taking a wrong partner, that's when you realize that, okay, that part was not compromisable. So is there because at times when S and M is there, probably ART, one of the 3 can be compromised, is what we, generally think.
Yeah. So S is the speed and the second M was what?
Minimalistic, interference and legalities.
Okay. I actually would put those in the A and the T, and let me explain why. Right? If a investor is accessible, then speed will happen automatically. That's where access comes in. We pride ourselves that we will come back to you with an answer, whether it's a yes or a no. We'll come back to you with an answer within a week. Why is that? It's a question of your time is valuable. I correspond that to access. I'm giving access to people, and I will give you an answer. In some cases, I may give you an answer today itself. Right? If you ask me a question, I may give you an answer. I may move on. But it's the accessibility which drives the speed, in my view. The second part, which is this minimalistic interference and legality, that goes back to trust. Okay, why is there law? Why is there legality in our society? Because there is a breakdown of trust. If you trusted every single individual in the world, would you need laws? If you knew that nobody would come and hurt you, nobody would steal from you, would you need laws? No. So fundamentally, trust is what drives, or the lack of trust is what drives the legal framework, this interference and everything else. That was my point earlier, right? That if there is mutual trust, then you don't ask questions. You expect that person to just come to you when there is a problem. That you expect that person to come to you when there's good news. You let the business run otherwise. So, that's why, it's a question of don't compromise. In my view, don't compromise on the relevance and the trust factor for the sake of speed. It may take you an extra week, it may take you an extra month, but trust me, please find the right partner to work with. If your gut feel says that this guy or this person or this woman or whatever is going to give me hell later on because of the way they're asking me questions, but this is the only investor that I'm getting, should I'll take the money in any case, don't do it. It's a worse decision to take money from a person that you don't feel comfortable with than not take it. You may grow the business slower, you may even shut down the business. But dealing with an investor that is a pain in the neck is much worse. I've seen that.
Hi, my name is Hemant. I'm an early stage entrepreneur ready to go live with my product and a lot of money. My question is, typically how long does it take for you to close the deal from the time you meet the entrepreneur? And what is the fastest deal you would have done and the longest you would have taken?
So the fastest investment we made, so we made the decision on the investment in a meeting in an hour, where we met this team and we told them to, so we met them in one conference room, we told them to wait in another conference room, and we gave them a term sheet in 2 hours. And it's a very early stage company, we by the time we did all the legal paperwork and everything else, it probably took us another month. Just we need to get all that paperwork in place. But the decision was taken in that period. We've taken as long as 3.5 years to make a decision. In another case, where the entrepreneur approached us and said that I want to take my business global, and I'd like you to put money behind us, and I'd like to work with you, and so on. And we said fine. We met with they were hiring 2 sales guys to take this business global. We met the 2 sales guys. We didn't think that the sales guys were any good. We told the entrepreneur that. So we weren't comfortable that the entrepreneur could scale the business, but with that model. So, but I like the guy. So I said, let's stay in touch. As you build the business, come back to me once a quarter, once in 6 months, whenever you think that you've made progress on certain things, and we'll continue. And so we stayed in touch. And 2 years later, he had a contract. That year, that customer gave him about $3 million in business, and it was still work in progress, but business was moving forward, and we engaged at that point in time. And he had a large angel investor that didn't want to bring a VC in but it was again this question of they were in a different industry, they weren't in the same, they weren't in the software space. This was a software company, and we finally convinced we had to convince the angel to take our money, and because the angel could easily write the amount of money I have in my fund, the angel is worth more than that as an individual. So he could have just written any checks that he wanted to, but he understood afterwards that we could add value beyond just money. And that company, since in the last 3 years, has quadrupled in size. So it took a while, but what we did was we told, the decision was taken in 3.5 years, but the primary decision was taken right away. We told the entrepreneur that we couldn't invest at that point in time, so we didn't waste any time. It was just staying in touch, giving feedback, all of that stuff, till the point we felt it's worth investing.
At this point, again, I want to ask a question on behalf of a lot of other entrepreneurs. That there's a lot of heartburn along the way because maybe strategies change, or investor and entrepreneur looks at the opportunity in different ways. So one may want to consolidate, one may want to grow, and different reasons of why there is a difference of opinion. So of course I believe that a lot of time, because of the passion, driven by the entrepreneur, there's a lot of emotions that come out, and there's a lot of difference of opinion between the entrepreneur and investor. How would an entrepreneur deal with such situations? Because at times that's when that boss and coach thing comes in and you say, hey, I wish I could have exited.
I thought I answered that question. Yes. Is that a major issue with most people here? That you have investors, that there's a disconnect with the investor?
The moment they put in money, they are going to demand, isn't it? That's how it is.
No,
Just one housekeeping announcement. There are 2 cars, 1892 and 1474. Whoever's cars. Just give the key. Just give the key. Yeah. Thank you.
So actually, I'm sure none of the people who are invested here would want to raise their hands for obvious reasons. But I'm not actually coming to the coach and the boss part of it. But what I'm just saying is that I feel is emotions one of the things that entrepreneurs should be checking, and are there other things that we should really be looking at? I mean, of course, we get this as Thai, and I'm sure that people are not going to raise their hands out here. So.
I don't really go to any of these because I enjoy the production. And more I think, yes, I don't want to do this, and I want to raise my own money, and I don't know what. This is the second time. So I think that.
yeah, which is why I wanted this show of hands, because I don't think it's as big an issue as it's always the squeaky wheel gets the grease, right? You've heard that statement. And in this case, the squeaking is happening between the investor and the entrepreneur. I don't know how often does that happen. I'm sure there are any relationship goes through its ups and downs. I think it's important to realize that. You said that, right? Even in a marriage, there are always good days and bad days. So as long as you are willing to accept that, and as long as there is, you check in your ego at the front door when you get in, I think from both sides, that has a big impact in the way the relationship develops over time. So goes back to this notion of trust. If trust is broken, then I don't think there's any way to resolve it. But if trust is there, then a difference of opinion is just that. It's a difference of opinion, and you can either address it through data. You can go back and you can look for data and say, you think that this market is great. I've gotten this research and that research and this one, and it may be a little bit of a waste of time, but you may need to do it just to maintain the relationship. The second, thing that one can do is you can involve a third party. It's not just a two-way street. There could be common friends. There could be experts. There could be other investors. So there are various ways to address individual flashpoints. See, if it's an ongoing flashpoint, then it's a loss of trust. But if it's an individual flashpoint at any point in your journey, then you can potentially address it through means other than I'm going to just get you an exit or whatever else. So happens in our companies. I would say I couldn't point to any one company and say we're always in sync. But if you're always in sync, that means you're not pushing each other hard enough. The biggest value that you add, and I said this in a talk we did recently, is when somebody asked me, or actually I asked another VC. So when we were setting up our fund, I said, from a partnership perspective, what is the thing that your partners add the most value? What do you think? Where do your partners add the most value? So this friend of mine said, I don't see most value when the partner is saying yes. So I present a business plan and I say, yeah, great business plan, let's invest. I find the most value when they ask me questions or when they say no. Because it forces me to think harder. And the final decision I take, it may still be a yes, but the final decision I take is a better decision. Okay? So if you take that approach in the way that you work with your investor, that will be hugely valuable. That when they're asking questions, don't take that as a affront of your authority, as a as a black mark on your entrepreneurship or whatever else. Look at that as a smart person who's asking you an intelligent question which needs an answer. And you need to think through, you are much closer to the business. They are doing 20 other things or whatever else. You are much closer to the business. So many times the questions get asked because of ignorance. Going back to this point, one of the reasons why you share data with your investor is to remove that ignorance. Keep them as much in the know of your business as possible. So when they ask questions, they're asking as intelligent questions as possible. Correct? So some of these things that you may feel are irritants because of questions being asked or data being requested and so on, take that as a positive, that I am going to educate my investor to be more valuable to me going forward.
Hi. Actually, the gentleman behind us was the quickest. I'm sorry. Yeah. Hi. I'm Kuldeep Kamath. I'm actually a second-gen entrepreneur. We're looking at actually raising money, but through a strategic investor. The gentleman behind us was the slowest and the fastest. This is a question related more to Nexus. What is the smallest and the biggest deals that you guys have done, a firm of your size? And secondly, like when you actually invest, how do you all generally squabble over valuations? And who determines those valuations? Like, is it like a cross the table discussion, or is it like a independent third party?
Yeah. So at our stage, there is no third party involved. It is between the entrepreneur and Nexus. Squabble is an interesting word to use. We have a pleasant negotiation. So there is no right or wrong answer to valuation. Number one, valuations can be done based on comparables. If you have other companies in your industry that you can point to and say this is what they are trading at, or this is what I'm trading at. But in most cases, in early stage, there is no comparison. So when a guy comes out of, so going back to your original question of what's the smallest investment we've done and what's the largest investment. So the smallest investment we've done is 250K, about a crore. And the largest investment we've done is 8 million. So it ranges. Our most common investment size would be between 2 to 5 million. So our horizon is 5 to 7 years. So the earliest we would see something at our stage would be a 5-year, where the company is maybe a little further along. So this software company I was telling you is potentially a 5-year exit for us.
I'm sorry, back to that question. But the next question is typically the traditional case you guys and then a PE investor or a larger investor who comes in.
There is no traditional path to investing. I've seen companies that raise money, that raised 150K, 200K and never raised money again. And there are people who have raised $370 million and taken a write-off. So it varies. It depends on the business, the nature of the business, and so on. Instagram, raised very little money and sold for $1 billion, right? So I don't want to. Maybe it's the nature of your business. So I don't want, because there are a lot of people here. So there's no. So I won't say there's any one path. You say I have to raise money now from seed, then I have to raise money from a VC, then I have to raise money from a PE, and I have to raise money from buyout. There's no set path.
So I'm sorry. So my business, I know that it's not the market opportunity, not so big that it's going to be an IPO kind of a business. But I know that's a huge opportunity for a trade sale. But I need to get big, add more muscle before I do that. So a VC firm would also be a good fit for getting up to a level where the VC and I say, you know what, we're going to get the best way we're both going to make a lot of money on this is we do a trade sale. Would you all put a company like yours be interested in it?
So let me answer that question in 2 parts. Is that a good investment for VCs? Some VCs are okay with that. So the nature of that investment is called invest to flip. So basically you invest in the company with the idea to flip it at some point to a strategic investor who is coming into the business. And so you say, okay, I expect that this business will go 3x, 5x, whatever, and then eventually I'll sell it. And that discussion happens at the time of investment. So, the two of us sit down and say, Sandeep, I don't think this can go IPO. I'm going to sell this business at some point. Would you still invest? So the VC coming in and saying, fine, I'm okay with that. I'm going to get a 30% IRR or whatever else. It's a reasonably short, let me do it. The other thing is to say, okay, I'll take this business to an IPO, it'll be a longer period. We generally prefer open-ended businesses which have the potential to be an IPO. I don't know the nature of your business, so I can't comment, but typically what we find is that if you are looking at your business in a very narrow definition, then somewhere along the way, it is possible to expand that vision. It's a question of maybe today you're not looking at that expansion for various reasons, resource constraints or whatever else. In the future, it could be that what you build as your base gives you the strategic flexibility to go in other areas.
Do you also fund startups?
Yeah. So this is not about Nexus. I was more about investing, but we do fund individuals. We funded guys. Like I said, this 250K was given to one individual that was working at a company, came to us with a very specific problem that he wanted to solve, and convinced us that they had the sort of technical know-how to do it. We weren't convinced that the product could be built because it was a very unique technology. So we said, okay, we'll take the risk, we'll give you 250K, build a prototype of the product, then we'll give you more money. So it was agreed beforehand that we would give them more money if needed. And so they built the prototype. The first prototype actually did not work as expected. They pivoted, they built the second prototype. That worked, we gave them a little bit more money because they had to keep going. So by the time they built the product, it was 400K, and then we put in $2 billion after that.
Let's say I want to understand the VC perspective. This is Samir Patil. I run a small company, Travel Tech, which is a travel media, online travel media company, and I'm looking to expand into another business. I wanted to understand your perspective. Let's say there is a very huge market size, and there are about 2 or 3 players who are dominating that space, but the market has space for a few more players. Now the market is so dynamic that an entrepreneur cannot come up with angel some $100,000 kind of an investment and then take it to, because there are very large players over there. But keeping in perspective that the market size is very huge and is growing, what would you advise to such an entrepreneur who has a very strong backing, has a very strong team also to take?
So Samir and I have spoken about this in the context of travel, right? So he wants to go build a competitor to Make My Trip or Yatra or ClearTrip. So the advice that I have for any of these situations when you have large players and you're coming in with a new startup, and if you were to go and compete with Make My Trip today, he's right. You can't start with 100K and expect to compete. To even get your initial clients or to get your airlines in order to give you the inventory, you would need to show a lot more. It's a tough answer. In those situations, it's typically today if Deep Kalra were to say, hey, I think I can do a Make My Trip 2 that is much better than Make My Trip, and do it, but to do that I need $10 million. I think somebody will write him a check. It's just what happens in those situations is that your prior history of being able to build a scalable business has a huge impact in the decision making for the investor. So you are seeing in the US, for example, right now, storage is very hot industry. There are a lot of large players. So there's EMC, there is NetApp, there are like 4 or 5 very IBM, HP, very large players in storage. Yet you have guys that are coming out of EMC, who's maybe he was the VP and general manager of EMC's high-end division, who comes out and says, I can build a better box than what EMC is building because the nature of the requirement has changed. The way that photographs are being stored right now is very different than the way financial data was stored when EMC was designed. So the nature of the storage itself has changed. So the nature of the hardware that I need to provide for that has changed, and therefore for me to do this, I need $20 million. They get that money because they are able to show that the underlying need has changed. They are able to show that what they are going to do is different. But to do that, they need this much money. Now, the same thing applies even in a travel space. You need to show that the underlying demand has changed. That people are expecting something else, which a yatra or a clear trip or a make my trip cannot provide easily. You need to be able to show that you can do it much better than they can. But to do that, you need this much money. So those are some of the challenges that you have to look at when you're going against large incumbents. That fundamentally, to replace large incumbents in established industries requires disruption in the industry. So you have to have a point of view as to what is the nature of the disruption. And my advice to Samir was, I don't see that disruption in the online travel agents, yet. Not in India. So, can you use? We have it. You have half an hour. Hello.
My name is Gagan Chaudhary. I have created a platform called entrepreneuradda.com which supports entrepreneurs in all the stages of their business. My question is basically I have been meeting various entrepreneurs and the biggest challenge in fundraising is, say out of 100 proposal, only 2-3 met the criteria of VC and angel investor. The rest 97% of the projects are not fit into the criteria. And still those guys are also putting their hard work. They have a dream and they even don't require 200,000, they require 50,000 or say 100,000. So for such entrepreneurs, what is the option available?
There's a person sitting in the back, Shweta, there's a person sitting in the back, there are multiple options here. Just reach out to them. So she's running India Angel Network.
Okay.
And she runs seed fund. So there are different layers, right? So it starts everywhere. So the entrepreneur, again, I'm assuming has exhausted their personal funds or their personal sources, and they need to get institutional capital. So today you are seeing everything from an accelerator. So there's a firm called Venture Nursery. There's a firm called what's its name? But there are like 3 or 4 guys that are doing accelerators in Bombay. Then GSF is in Bombay.
Yeah.
GSF is there. So there is obviously these guys. Then there is then you have the angels who are providing capital, and again, if they're relevant, are providing a lot of advice and a lot of connections and helping in hiring and so on. So get relevant angels. Once you outgrow that, you could potentially go to Tanya and convince her to put a larger check. And so there is going back to his question, right? So there are various levels. Now you don't need to do all of them, right? So you could be doing angels and coming directly to me, or you could be doing angels and going directly to private equity funds. So there are various models that work, but there are, again, this goes to the relevance part. There are different stages and different size of companies that get created, and typically you can find different investors for each one.
Yeah, I've tried with angel investor and other guys also. They also have their own criteria, and again, only 2-3% of the project gets passed through their criteria. So 90% of the project again remain unfunded, or they have to look for some private sources or something like that. So that is the biggest challenge. We can think of some crowdfunding, or everybody who can have some smaller risk and create something for these guys, so that.
So there is crowdfunding. There is a platform. Kickstarter. No, Kickstarter is. I don't. Is the Kickstarter in
No, not Indian. Not
is it Indian? No. So you can put it on it, but there is a. I'll Paula knows, so you can ask Tanya afterwards. So Paula has a. She put me.
Which very only support social cause.
No. So she sent me a link for small business funding, which Nachiket more runs. I'll have to, but you can just get that. So it's actually a very interesting thing. I didn't know this existed in India. So she sent me a link to a guy who's running a sweet shop at Kempscott, and he's looking for 20 lakhs to improve his things that he's selling. And interesting. And Interestingly, he's actually got money, he's got 20 lakhs from people who stay in that area, Carmichael Road, Altamount Road, and so on, because people have been buying sweets from this guy for ages. They know him. But see, you can't go to any individual guy and say, give me money. But if you create this platform, people find out that this guy needs money, and people don't mind giving. So I know Paula's given money to that guy. So that,
okay, thank you.
No, so it's a very interesting thing. It's not an investment. It's not shareholding. So that applies for shareholding. So this is effectively a low interest loan.
Not more than 50 directors.
No, not 50 shareholders. 50 shareholders, but this is not. You're not a shareholder. You're just giving money as a loan.
Hi, my name is Nitin. I'm founder of a company named contractorbuy.com. We are helping Indian homeowners to make more informed decision during the renovation process. My question is on the relevancy part. So, a lot of companies are, they are a mixture of online and offline model. Like in my case, there is a lot of things happening on web, and there is a real world service. So when you said you have to find relevant investor, it's a very tricky situation. Should I give more importance to someone who is into the real world construction part, or I should look for someone who knows how to expand on web and take it further?
Where is your gap? Where is the biggest? Are you a web person trying to do offline, or are you offline trying to do web?
I'm more on the website. Yeah. So
I think get somebody who brings you the experience on the offline side.
Okay. There was one more question. It's a silly question. When you get first round of funding, or maybe somewhere down the line, how much is your personal, the founder's take home out of it? Like, does he get rewarded out of it, or it's all business money?
So, number one, one thing I want to say is there is no silly question, right? Feel free to ask it. One of the reasons why we do this in an informal format is to give people an opportunity to ask any question. So, I think it's a very fair question. The founder has two roles to play. The founder has a role to play as a person who ideates the business and is running the business, is ideating the business, and the brains, sort of the torchbearer, right? And the second part is the person is a manager. So, as an employee of the company, you should get paid. If a investor is saying, don't take any money out of this thing you're getting, and then you have to get compensated for that in other ways. So there are people who say, hey, I don't want a salary. I was at Infosys earlier, and I made so much money on stock options, I don't need a salary. So I will want to have maximum amount of equity. So they go back and they say, fine, no, I will take $100,000 or $1 million or $2 million, whatever else. I will not take a salary. It'll all go into the business. But if I was taking a salary, my salary would be, based on my prior history, my salary would be 100,000 a month, 100,000 a year. Therefore, I should be compensated for that as if I was putting money in. So that's one way to look at it. Now, how does that compensation happen? Part of that compensation happens in the form of the equity that you're given. So you can either ask for more equity as ESOPs going forward, or you can ask for a better valuation or not taking salary. But that discussion, it is best to have that discussion. Don't be shy about that discussion. Because if in the back of your mind, you're thinking, how am I going to live? But you're also worried that if you ask that question, the investor will not give you money, you won't be able to run your business because you're always thinking about how to live, right? So it's in nobody's interest. The investor is also not being helped by this constant struggle you're having on the personal side. You can't focus on your business. So, we've had situations where we've actually paid an individual coming in over 1 crore a year in salary, with a very clear expectation that if he did not take that crore, he would own 20% of the company. If he took the crore, he would own 8% of the company. I said, you choose. And I said, no, because of my personal commitments to my family. I have an ailing mother, I have to take care of her, and I have a daughter who's going to college in the US, I need to pay for tuition and all that stuff. I need this much. So I'm willing to take a lower equity. What is my reaction there? I say, this guy is not taking any risk. So how does the investor look at this, right? The investor says, for him this is a job. If he gets an additional 8% in equity, it's great for him, right? So that is what you have to overcome in this discussion. So what you have to convince the investor is that your passion is no less. But to meet your needs, and these are needs that are, if you say, hey, I need to drive my Lamborghini, and therefore I need to take a salary of crore, people will laugh at you, right? But if it is genuine need, then investors also understand that if that genuine need is not met, you will not be able to run your business. So that's the key thing. If you can, and if there is a genuine need, have that discussion upfront. Don't do it after the money has come in, because then you are, again, this is all about expectation management. Put the sort of cards on deck as early as possible, so that there is no surprises later on. Nobody wants surprises.
My name is Lalit. I work for a leading media company. One of the first summits, an event that I'm attending. So I might have a very basic question, more towards what you mentioned on relevance. In the Indian ecosystem, is there a mapping of each VC or a PE and the kind of funding, the sweet spots they have, the values that they work on, what kind of exits they look at? And might just not be an excess question, it could be a type question as well.
I think there are various IBCA I think has a list of all the VCs, how much do they invest and so on. VC Circle has I think a list as well. Most of the VCs and investors, whether it's IN, whether it's us, most of the investors have websites where so at least the institutional investors all have websites which list the investments that they have made. So you get a sense of what are the areas they're interested in. One of the things that I would recommend is when you take money from an institutional investor, please look at their website and try and understand that match. I think it's a good question. Try and understand that match. So when you come in for a discussion, that relevance thing is already, you're not wasting time, so you can only focus on the relevant investors. The other thing that I would recommend is that once you look at that website, see if you can get in touch with anyone or you know anybody in any of the portfolio companies. If you can come to an investor based on a recommendation made by one of their earlier investee companies, that's the most powerful way to get to an investor. No investor wants to piss off their investee companies by not taking a recommendation from them. So maybe after, if we get 4 or 5 bad recommendations, then we tell the guy, don't send me anybody. But normally, what we find is investee companies understand how we work, so they only recommend people that they think would be a good fit for us, and therefore, when they recommend someone, we take it quite seriously.
2 interconnected questions, again connected to relevance. Is there I think you mentioned that while you were talking, that there's no structure that you have to start with an angel, then go to a VC, then go to a PE. If you're looking at large funds to start off, say, I don't know, maybe 15 million as a fund to start off, then is a PE a better bet to go into than a VC in that perspective?
Yeah, sure.
Sorry, just before you answer that, there's a car 1474. I think it's parked in front of some of us. So, anybody with a car number 1474?
Yeah, so if you need a large investment like that, then normally you have to go to guys who put that kind of money in. However, VCs do work in partnerships, so if you need 15 million and it's a much earlier stage investment, then maybe 2 or 3 VCs can get together and invest. So that does happen. We call it syndication. So we do syndicate deals.
I get that you go to the right people who are able to do things for you rather than just shoot in the dark and go to many people and.
Correct. So if if the relevant investor is the VC type investor, then syndication with multiple investors is probably a better idea.
And I mean, what do you hear most about?
Running on time, shorter time, so we have 10 minutes. We'll come back to you.
Good morning, my name is Vishal Sanghvi. We run a business of internet telephony voice over IP. We have 50,000 plus customers and daily 1 million of hits and 10 crore of revenues. We want to expand our business in India with the data, voice and video using our internet service provider license. So I want to know your view to have I use the word coach instead of investor. So as per you, your views, how many coaches should be, good for the company?
So, I think the word itself sort of defines the way you should start. So a coach, Federer only has one coach. The coach may change over a period of time, but he works only with one coach. Because you can't have two people giving advice, you hit this way or that way. One person defines it. So at any point in time, you should define that one person as your main coach. Now what you'll notice is that a board, as the company grows, a board goes to more than one investor many times. What we do in most of our investments is we define a lead investor. And that lead investor then plays the role of that coach. And then everybody else is available on an as needed basis. So you can think of it as, we are sub coaches. And that lead coach is bringing you in to say, अच्छा इसका backhand ठीक नहीं है, इसका backhand ठीक कर दो. And the other guy will say, okay, footwork ठीक नहीं है, इसका footwork ठीक कर दो. Right? That sort of stuff. But the main coach is the one who's sort of determining what needs to get done. And that is very critical because otherwise the entrepreneur can just go, bonkers trying to manage multiple coaches. So that's sort of the model. So at any point in time, always work with one lead coach. One other suggestion that I have is that this notion of coaching, if you don't need the money, you guys may not need the money, you're able to build a business, still try and get somebody to be an independent board member. I think it adds a lot of value to have somebody who is looking at the business outside of the day-to-day activity. Somebody again, the same things apply. Somebody who's relevant, somebody who you trust, somebody who's accessible, who can work with you. But even if you don't take money, get that person on board. Having a thought partner is extremely valuable in any business. I always say that entrepreneurship is a very lonely journey, and sometimes having someone who is not tied to the business on a day-to-day basis is extremely valuable because they can look at things dispassionately that you will not be able to. So that I just want to put that as, even if you don't, investor could be a coach, but even outside of investors, you can still get coaches. Yeah, so the question is that what is the expectation of a independent board member or a coach or whatever else? It varies. There are professionals who do this for a living. So there's this whole executive coach model. I have a friend who runs a very large consumer goods company. He brought on board a guy named Kasturi Rangan, also Kaz, his nickname is Kaz. So Kaz was executive director of HUL at one time. Retired, lives in the US, comes to India, for these meetings. He's an executive coach, and he's been working with my friend for the last 4 years, 5 years, and on a paid basis. He charges whatever 1 lakh, 2 lakhs a day, and he comes and he spends time. But before he comes there, he has actually gotten papers. He reads the papers. He knows exactly what to discuss, and has viewpoints on how to have that discussion. So there is the professional executive coaching industry that's out there. There are also people that do this because they're just passionate about working with entrepreneurs. There are folks that will do this for no money. People who will do this just because they want to stay in the flow of things. They may have retired, but they don't want to necessarily, they don't want to take money because exchange of any money, equity, whatever else, results in expectations. So when you give somebody some money, you will expect them to do something for you. So they say, I don't want any money from you, I don't want anything from you, but I don't want any expectations to be set. I'll make myself available. You can call me, do whatever, but I should not feel guilty if I'm not available. So the people who do that, and then there are people who will come on board and will expect some equity when they come on board. So typically what I've seen is numbers ranging from 0.1% to 0.25% of the company to be advisor. And if you get them on the board in India, see in India one of the challenges of people coming on board is the fiduciary responsibility that comes in the Indian company law context. The Indian company law is very, very punitive when it comes to directors. So it's very hard for small companies to get independent directors for that reason. So board members can expect a lot, either in sitting fees or large sums of equity. Could be 0.5% to 1%.
We have a couple of advisors who we actually approached here. They are actually, one of them is Dr. K.K. Noria, ex-chairman of Crompton Greaves. He's Nitin Noria's father by. And the second one is Mr. Homi Khusro. He's actually ex-managing director of Tata Tea, Tata Chemicals, Glaxo. These are gentlemen who, even if you offer them money, they will get offended. They will say, look, I'm not here for the money. What do you think? I made 3 crores last salary. What do you, I mean, your equity and all.
That's a very good point. Actually, yeah, you're right. Sometimes offering something can actually be an insult also. But that said, in that situation you don't offer money, right? Yes and no. It depends on the nature of the person and your relationship with them. So they will not do it. Again, the reason why the both of them will not do it is because they don't want any expectations to be set. It's not just about offense. Most important for them is that they don't want obligation.
I think we have time for last 2 questions.
Yeah, my name is Manish Vora. Actually, I'm an entrepreneur for the last 22 years, and recently I started a portal on trade fairs and services where you use the system at the fair and after that online. My question is actually about this raising money and all those things are really very critical. So this recently SME exchange has started. So how is an angel or a VC looking as a SME? Because that would be an exit for him where some cases it requires huge money for an IPO on those things. So how do a angel or a VC look at an SME, which is though a new development, but at least I have seen at least 15 or 17 companies have raised money in the last 3 months, 3 to 4 months. So how do you look at it? Another thing about that Kickstarter also, what I said, there was one company right now it's going on. He had just invented a 3D pen actually, and that fellow wanted $30,000 and he has raised, as on today, $22 lakh. Around 12 crore rupees he has raised. So it's a platform where we can use it for saying how your idea can work, or you can have a trial run on there. Though India doesn't have, I think, a Pitchberry or a small one, but I think a Kickstarter or a India, something like that would do. Thank you.
Yeah, I think I just check whether Kickstarter can. The issue I think with that is in India, whenever you do there's a FICR, foreign inward remittance, FIRC remittance confirmation certificate. Yeah, CS over here would go better. But so in that situation, when you're taking money in, individuals are sending money.
Sorry, I just need to announce the car keys for at least, we need car keys for almost 7 cars. They are blocking, 1682. Anybody? 1682? 1474. It's written twice, so I'm sure this is parked somewhere in a very odd position. 4517. 1160. 5398. 5398. 6758. 6119.
We should probably wrap this up because 7 cars is never going to manage. Next time balance service, huh? Next time balance service for car. Yeah, so your question was this SME exchange. So, I haven't spent, I did some initial sort of discussions with those guys on the SME exchange. None of our companies have listed there. The issue with exchanges is liquidity. So I don't recommend SME exchanges to my companies, at least till they, because you can list there, your share price gets publicly known, and if there is no liquidity, then the share price can drop dramatically, and in effect, your business becomes very hard to raise capital going forward. Right? You can't do it. Okay, so maybe there are rules to address this issue, but I think those are some of the things that. But if it is a reasonably large company, so for example in your case, you could potentially look at the SME exchange as a means to raise capital. The advantage of SME exchange is that you don't have one boss. You have point. The disadvantage is that the risk of the share price dropping dramatically or manipulation of your stock price. This is Ketan Parekh happening again. Just be a little careful on that.
Hi, my name is Kiran Ajwani. I'm a business coach by profession. My question is actually keeping my clients in mind. Are there any companies or investors specializing now in family businesses who are professionalizing and in turnarounds? Because I have clients in that space.
Yeah, so family businesses, it depends on the size of the companies.
The reason I mentioned family business is a specialized thing because they have their own.
No, absolutely. We generally shy away. We, for example, shy away from family businesses.
Because
for various reasons, family businesses that have been around for a long time have a certain DNA built into them in terms of decision making, in terms of cash management, and not necessarily negatively. I'll give you. So I have a friend who is part of a large family who runs a BPO, and the shareholding that they have in that business is owned by the family, not by him as an individual. So unlike other BPOs where the individual holds the equity and therefore as the company grows, you are seeing your own personal wealth grow. In this case, you're generating family wealth. His family business is in trading, commodity trading. Goes through its ups and downs. There are periods when there is a lot of cash being generated from that business coming into the coffers of the overall family, and the other times they are not. So this guy is, always dependent on cash flow coming from there to support his own needs. Family gives an allowance to everyone. All the money that is generated goes into the family, and then his allowance is given to everyone. So his compensation is also not determined by the company. So he came to me once and said, Sandeep, how much does a person who's running a BPO that is 40 million or 50 million in revenue, what is their salary? I said, they should be making about 1.2 to 1.5 crores in salary if it's a profitable business. Because I don't get anything close to that. So the incentive structure in that family business environment is so screwed up for a third-party investor coming into an individual business, because that person who's running the business is not as well incented as an individual entrepreneur. So I would personally always prefer to invest in an individual entrepreneur.
Can I? Okay. So when they're professionalizing, that means actually they're changing, right? They're coming from a past, it's solid, profit making, but now they are looking to embrace a new future. So that's.
Yeah, but professionalizing in what way, right? Because again, the decision making is actually
letting go of controls, putting professional management teams in place. Anyway, so are there any people like that you know of?
Yeah, so Ambit Pragma does this. So there are a bunch of these smaller PE funds, Tano Capital, Ambit Pragma, India Value Fund, bunch of these guys that are sort of in this space.
And turnarounds specifically?
Turnarounds as well. So IVF, for example, is very focused on turnarounds. They will buy They will take majority control and turn around businesses.
IVF.
India Value Fund. India Value Fund.
Okay, thanks.
I think that was the last, and on behalf of everyone, thank you, Sandeep. Just one last thing. We have a list of different kind of features and cases. So we at CHAI, with the help of a lot of volunteers, had put a list together in terms of the fund names, the geographies, the fund value, and the interests. So it's available in a booklet. Like, is it online as well, Tarun?
On TIESmashup.org.
On TIESmashup.org.
Awesome.
Yeah. So TIESmashup.org, you'll find that list as well. Thank you. Thank you, Sandeep.